Today, we're diving deep into why AMC stock holds the greatest potential for upside gains amidst the ongoing financial turmoil. We'll explore recent developments, including margin calls affecting major banks, and how the suppression of AMC's value is actually building a bullish case for this stock. Stick around to hear more about the factors driving AMC's future growth, how liquidity issues in the market are impacting the suppression of AMC's price, and why institutional investors might soon be forced to buy back shares at significantly higher prices. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone, remember, this is not a financial advice video. Let's start by understanding the broader market dynamics and why liquidity has become such a critical issue for hedge funds and financial institutions. The problems began in 2021 when retail investors, popularly known as apes, started holding AMC stock, disrupting the usual operations of hedge funds and creating a massive liquidity crunch. Banks, in response, began borrowing heavily through reverse repurchase agreements, repos, to maintain their financial stability. The rise in reverse repo transactions indicates that banks are in desperate need of cash, a situation that becomes increasingly problematic as they continue to deal with declining liquidity. On this channel, we frequently discuss the reverse repo market and its implications. This instrument allows institutions to gain access to capital quickly, but when borrowing outpaces available capital, it signals a larger issue, a potential liquidity crisis. Hedge funds and banks are now grappling with this reality, making it harder for them to continue suppressing the price of AMC stock. Now, let's talk about why AMC's price is not reflecting its true value. One reason is the consistent suppression of the stock through various financial mechanisms. Despite AMC's fundamentals improving over time with lower debt levels, better cash reserves, and a booming box office, its stock price remains subdued. This suppression has led to a growing disconnect between AMC's actual value and its current trading price. But here's the catch. This suppression is building up immense pressure. When that pressure releases, AMC could experience an explosive upward movement. It's not just the fundamentals that make AMC a compelling buy. Consider the broader market sentiment. Hedge funds have created billions of synthetic shares, and institutions are manipulating the market to drive the price lower. As a result, retail investors remain steadfast, holding on to their shares, waiting for the inevitable short squeeze. Remember, the more these hedge funds try to suppress AMC, the more tension they build, and the more significant the upward movement will be once the suppression is lifted. Now let's address the elephant in the room. Margin calls. According to a tweet by Phil4Real, it's evident that banks are nearing margin calls as their liquidity dries up. The margin calls are a direct result of hedge funds' inability to cover their short positions on AMC. Since the banks are the primary lenders to these hedge funds, any inability to meet these margin requirements could trigger a domino effect across the financial sector. With banks now struggling to maintain liquidity, many have turned to the Federal Reserve's reverse repo facility for assistance. But here's the kicker. The demand for liquidity through these facilities has shot up, while the actual capital available to borrow has declined. This means that banks are scrambling to stay afloat, let alone support hedge funds' short positions on AMC. It's a precarious situation that could force these financial institutions to either liquidate assets or call in their loans, leaving hedge funds in a bind. Let's shift gears and talk about a high-profile exit that's catching everyone's attention: Warren Buffett's recent sell-off of Bank of America shares. Buffett has been offloading millions of shares, reducing his stake to just below the 10% threshold, which means he's no longer required to report his transactions promptly. This move is significant for a couple of reasons. Firstly, Buffett is freeing up cash. For a seasoned investor like Buffett, this usually signals that he's anticipating a market correction or crash, a time when stocks become more attractive to buy. Secondly, selling off a major position like Bank of America suggests a lack of confidence in the bank's future prospects. If a prominent investor like Buffett is losing confidence in a financial institution, it's safe to say that the bank might be in trouble. But who's buying these shares back from Buffett? Interestingly, Bank of America itself. The bank has renewed its $25 billion stock repurchase program, buying back shares to maintain its stock price. This is a desperate move, as the bank is using up its liquidity to purchase its own shares instead of strengthening its balance sheet. Given that Bank of America is a direct prime lender to Citadel, one of the main entities involved in shorting AMC, the liquidity crunch could spell disaster for both the bank and Citadel. One recurring theme we've noticed is the blatant manipulation of AMC's stock price. When AMC receives good news, its price drops, a clear indication of manipulation. If no one is selling AMC shares and more people are actually buying, why is the price falling? The answer lies in the market manipulation tactics employed by hedge funds. They want retail investors to get frustrated and sell their shares, increasing the liquidity of AMC shares in the market. This manipulation is not just unethical, but also unsustainable. And with liquidity drying up, hedge funds might soon find themselves cornered. A tweet by Joshua Sky points out that the criminals manipulating AMC are on the brink of a financial disaster. Nobody is selling, and the only way for hedge funds to cover their short positions is to buy back the shares they've sold. To do this, they might have to liquidate other assets, further straining their financial positions. With AMC's fundamentals continuing to improve and the movie theater industry showing signs of recovery, it's only a matter of time before the tide turns in favor of retail investors. One of the most compelling aspects of AMC's bullish case is its improved financial standing. Compared to 2019, AMC has reduced its debt, doubled its cash reserves, and is expanding its revenue streams. CEO Adam Aron recently announced a $100 million investment in Coca-Cola Freestyle machines, showcasing AMC's ability to make significant capital investments. Such moves signal confidence in the company's future and its ability to generate strong returns. The management strategy to invest in new revenue streams and innovative initiatives places AMC in a stronger position than it's ever been. With less debt, more cash on hand, and a loyal retail following, AMC is well positioned to capitalize on future growth opportunities. Once the manipulation ceases, AMC's true value will emerge, making it one of the most promising stocks in the market. In conclusion, AMC's bullish case is stronger than ever. The manipulation and suppression tactics, liquidity issues at major banks, and recent margin call threats are all factors building up pressure that will inevitably lead to a massive upswing for AMC. As retail investors continue to hold, institutions are being forced into a corner. The moment they run out of options, AMC's price will skyrocket, reflecting its true value. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.